Welcome to Legacy Elevated. We are here to equip, empower, and inspire the next generation through business and community leaders. Legacy Elevated will revolutionize your business beyond the P&L to further shape your identity as a company and your evolution as a brand. Legacy Elevated focuses on global impact you can have by being hyper-local in charity and community while living with your future legacy in mind.
Lending, mortgages, refinances. Is now a good time? Should I wait? Where will rates go? Who has that magic crystal ball? And what do I need to know this year that will impact my wealth portfolio, that will impact what I can buy, sell, or even keep as I'm looking at long-term holding assets, what that looks like within the lending world. Excited today to bring you a Melissa Bell of McLean Mortgage, and we're going to dive deep on everything you need to know when it comes to refinances, lending, and interest rates. Hey, Melissa, how are you?
I'm great, James. How are you?
Good, good. Thank you so much for joining us as we get into the dirty of lending world and what that looks like.
Well, thank you for having me.
So right now, the amazing trend we're seeing is everybody that owns a home is refinancing. Why are they refinancing right now?
Because rates are at historic lows. They are the lowest they've been since rates have been recorded. Most people have never seen rates as in the twos, which is amazing. So those that purchased or refinanced last year or prior to COVID are seeing a big savings in their monthly payments.
Now, I've also heard sometimes you should not refinance. So if I'm listening to this thinking, maybe I should refinance right now, who is a candidate to not refinance?
Those that have only been in their home for a small amount of time and put a limited amount of cash down, it may just not make sense. And those that are pretty close to paying off their home or moving within the next couple of months or even up to 3 years. If you know that you're moving within that 3-year time frame, sometimes it's really not a good idea to refinance.
Right. I've heard that buzzword recapture time, right? And so in your estimation as a lender, how many months or how many years should it take me to make it worth it?
I would say no more than 3 years. That's the key target for us is it has to make sense and you have to recoup those costs within 3 years.
Now, obviously, it's going to be variable to the price of the home, I'm assuming, or the loan amount. But how much on average should I equate a refinance to? A lot of people are thinking, should I refinance? Should I not? How much will it cost me? What do those typically run?
Closing costs and setting up your new escrow account, which is what we call prepaids, are around 2% of that loan amount. And what I always tell people is you're going to get a lot of that escrow money back because when you pay off your current mortgage, you're going to get a refund back to that. But from a cost perspective, I always use, a percentage, which is about 2% of the loan amount.
Now, I've heard of a thing called a no-cost refinance, and what does that mean?
Well,
Is that
no
true?
cost
Is there
refund.
even one of those things?
And in the end, there's not such a thing because what a lot of people do, they will increase the rate so the lender can pay those closing costs. So you would be in turn paying a higher rate to have nothing added to your loan. You would just start over with your current loan amount.
Yeah, and I've seen that. It's almost like a magic show, right? They say, well, there's nothing here, and then all of a sudden they've added it. I had a client recently, I couldn't believe it. They had an online lender that had given them a quote where they had origination fee, they had a discount point, and it was actually for a veteran, and they had $6,000 of charges, and it did not decrease the rate that was market rate. Have you seen that as well?
Correct. And that's why I always suggest everyone to use someone local because our reputation's at stake. The online lenders, they don't have to be able to answer the phone. They can hide behind the computer screen. But yes, you just have to make sure you're using a reputable lender so that you know you're getting the best possible refinance or purchase deal.
Now, when people purchase a home, many lenders have them sign what's called an amortization table, which can be very daunting. However, there's a time where the interest flips to the principal. So if I'm listening to this and I've owned my home for X amount of years, Is there a time where you don't recommend refinancing?
Well, it depends. Every person's situation is different. I have a lot of people that are planning for their kids' college. Maybe they haven't been able to save money for the kids' college. Now is a great time for them to pull some cash out to be able to take care of a few years of college and not have to worry about student loan debt for their children. Every situation is honestly different. But if you have been in your home for 10 to 15 years, it may not make sense unless you're wanting to shorten the term and do a 15 or a 10-year refinance.
And how does that work? If I refinance and I squeeze the time down, does that mean the rate goes down as well?
Yes, the lower the term, the lower the rate would be. So, 15-year rates are a lot cheaper than 30-year rates, because most likely people that are going to take a 15-year note are not going to refinance because they've paid so much into it so fast.
Mm. And when it comes to refinancing, obviously you already talked about, well, there's the recapture period, right? Does it make sense? Well, I've even heard the joke that the only time it's not good to refinance is if you sell it or the rates drop even lower. So let me ask you this question. What are the rates today? We won't hold you to it, but as of right now, as we're speaking, what is the rate?
On a 20% down purchase, you were looking at the mid twos. A refinance is a little bit higher than that because refinance rates are higher than purchase money right now. But that is based on at least a 740 credit score.
And why are interest rates higher for a refinance right now?
Well, right when COVID hit and rates started tanking, everybody and everyone was refinancing, and that saturated the market. And the mortgage industry and title industry honestly could not keep up. And then mortgage servicers were losing money because the servicers of your mortgage, they buy them so they can make the interest off of your loan. And when you're paying them off, they're not making that interest. So Fannie and Freddie came in and said, we're going to try to limit the amount that are being paid off quickly and add this additional fee. And the fee itself is not charged to the buyer, so to speak. It's charged to the lender, which in turn the lender would raise your rate so that they can absorb that cost.
Yeah, no, as far as tracking interest rates, I thought it was very interesting. You said that they're not only historically low, but they're the lowest that's ever been recorded. Put you on the spot here. When was the first year they were recorded?
James, I believe it was over 40 years ago.
Wow.
But I will have to double check my numbers.
Okay, so over 40 years ago, they started recording rates, and we're at that lowest moment. Now, there's a term I've heard, and I think it's a lending rule, but 1%, 10% when it comes to interest rate and home affordability or sales prices. Can you explain what that means?
Well, and I like that rule, but a lot of the times it really depends on the client's total debt, because they may have car payments, student loan payments that someone else may not. So the affordability piece is going to change depending on their total income and debt ratios.
Sure. Okay. Talk to me about buying a home now. And there's terms we hear was conforming, jumbo. It seems like every time I turn around, there's a different number for jumbo. There's a different number for conforming. I know that you do loans throughout the country and especially in the DMV. Can you give us an idea? I know it's specific to regions, but what it is in the DMV right now?
So the conforming loan limit nationwide is 548,250. So anything at that loan amount or lower would be a normal conforming loan. And then in the DC metro area, we live in a high cost area, as you know, that they have a high cost loan limit, which now is 822,375. So as long as your clients can have a loan amount of 822,375 or less, it would be a conforming loan, just a high balance. So anything over 822,375 is considered a jumbo loan. The jumbo loans were hit pretty hard with COVID, so the requirements for them are a lot stricter than they were prior to COVID. The credit scores have to be a lot higher. They have to have quite a bit more of assets when they close. And their debt ratios have to be really a whole lot lower than a normal conforming loan.
And how does that impact me, perhaps for interest rates? Like if I'm trying to get below 822, or if I'm above that, is the rate higher?
So right now, jumbo rates are trending higher than conforming rates. So you're looking at probably a quarter of a point higher for a jumbo loan versus a conforming loan.
Now, some of those are consumers online that have picked up this podcast and trying to figure out, okay, if I'm shopping rates or I'm shopping between lenders, what are the key components I should look at? Like, what are the top 3 ways that most people miss when they're trying to figure out who I should go with?
Well, I always like to say if you look at your rate and the APR, that's going to tell you what the lender's actually charging you the day of closing. But in reality, the lender fees and the rate should really be the only things that and I won't say only things, but when you're comparing, because your escrow account, which is your prepaid account, and all of the title and recording fees are going to be the same no matter what lender you use. So if you are looking at the lender fees, which would be origination, discount, underwriting and processing fee, if you look at those fees plus what their rate is, that's going to give you a true comparison of the better loan product.
Now, as I'm looking to get qualified, tell me about debt to income or DTI and what I should know about that.
So there's 2 ratios a lot of people aren't familiar with. There's your front ratio, which is your housing expense. And some people do forget that if you have an HOA, homeowners association, or a condo association, that payment does go into the calculation of your housing ratio. The perfect scenario would be a housing ratio no more than 36% of your gross income. And the ideal situation for the back, which is the housing expense plus all of your other debts. And by all of the other debts, I mean car payments, student loans, installment loans, credit cards, any other debt that would be reported on a credit bureau. That the ideal situation would be obviously 42 or less. Conforming FHA and VA do allow it to go up to 50%, but there's a lot of compensating factors that have to go into it.
Let's talk about credit scores and debt payoff. And I've seen different lending institutions take different angles on it. So let's say I have debt right now. Maybe I have a car loan, student loans, those type of things. Should I save up cash to pay those off before I go buy a home or get a loan, or what should I think about?
And that is a discussion that you need to have with your lender, because we can run scenarios for you to see if it makes sense from a credit standpoint, because you could go pay off everything that you owe and your score decrease, which that's what we've seen. So we try to tell people don't pay off anything until you talk to us, because we can see things that maybe you can't, but sometimes paying off debt is a detriment.
So let's talk about credit scores for a moment, because I think that's what paralyzes many people, where they're like, oh, I don't think my credit score is good enough, and I have had issues with my credit. What should I do? I don't want to talk to a lender yet. What are some of the, different, is it 600? Is it 650? Like, where do I see the best interest rates? And what are you seeing across the board right now?
Anything that is a 740 or higher is the highest tier for credit score. I mean, for rates with your credit score. But you can have, as low with us, as low as 600 and still get approved on an FHA or VA loan.
Oh, wow.
So yes. So, but not everybody, just because you have a 600 doesn't necessarily mean that you're going to be approved. But I wish that people wouldn't be so scared of the credit score, for the simple reason that it does not always mean that you're not going to be approved for a loan. We may have to do a different product. If you have a 620 credit score, we know we have to do conventional with 20% down, or we have to go FHA or VA for that matter. But there's just so much that they need to talk with a lender to see what they can actually do.
Yeah, absolutely. It's going to be case by case. And, so let me ask you this. It sounds like this is true. If I'm at 750 or at 800, is my interest rate basically the same?
Yes, it is.
Okay. Wow. And then now here's the question I get all the time. If I talk to Melissa, if I talk to a lender and they pull my credit, I don't want to do that, because it's going to get hit and it's going to go down significantly. So can you tell us the truth behind the myth?
Generally, with one credit pull, it's not going to be a detriment. And we always like to tell people that they should have the ability to shop. And from that first mortgage credit pull, they have 30 days to shop other mortgage lenders. But what a lot of people forget is they come to me apply for a mortgage and then go to Best Buy or CarMax and then go apply for a mortgage, and then your scores would be greatly hit because you've done a couple of different credit pulls. But the initial credit pull should not have an immediate bearing on your credit score. I think the last person I talked to said his went down 2 points. But another key piece while we're talking on credit, a lot of people focus on the online credit reports, and they are oftentimes not anything like a mortgage credit report. I often joke that the online credit reports are kind of like algebra, and the mortgage credit reports are kind of like calculus. They have a lot more layering to them.
Right. Well, and everybody gets excited because they pull Credit Karma or whatever the commercial is nowadays of the newest way to know what your credit score is. What do you pull all three credit? Where do you guys go to pull the credit to figure out that, what, James, you have a 750? Like, where are you pulling from?
We pull from all three credit bureaus, and we take the exact middle credit score. And while we're on this topic, if you apply for a mortgage and I apply for a mortgage, we're buying a house together. I have a 750, you have a 760. We still have to use my 750. We use the lower of the two scores. And a lot of people think, well, if I add my mom, she's got an 800, I'm going to do better. But we still have to use the lowest of the two.
And what are the three credit bureaus that you pull from?
TransUnion, Equifax, and Experian.
Okay. And does it usually range big time, like between one and the next?
No, most of them are all pretty close to the same. Now, you have some areas of the country that a lot of their like local banks only report to one bureau. So you may have one that has a lower or higher on one particular one. That's just because that bank only reports to the one credit bureau, because the creditors have to pay to use that credit reporting, to report to the credit bureaus. So some of the local small town banks will only report to one bureau just for a cost perspective.
Yeah, that makes sense. And when should I have my credit pulled? Let's say I'm 6 months out or 12 months out. Should I still have it pulled right away, or should I wait until I get closer to when I'm actually ready to buy a house?
Well, I'm kind of torn on this. For those that know they have no credit issues and monitor their credit, yearly, you may not have to go ahead and pull credit until 3 months prior to buying a home. But for first-time home buyers, I really like for them to pull it as soon as they start talking about buying a home, because it gives us time to fix anything that could be hurting their credit scores. They may have a collection that they paid off that's not been reported as paid off. And we have time, and that's less stress for you as an agent as well.
Now, if you find a problem, I heard there's like a credit cycle. So if you find a problem and you're able to fix it for them so that they can buy a home, how long does that take? Can that be done in a week, or is that?
Well, we have a couple of different avenues. There's a rescore piece, and that's what you're kind of talking about with the week. And we would like to say a week. Now with COVID, it's taking maybe 10 days. But if we can fix the problem and have proof of it, that's the key piece, is proof, then we can send it to the credit reporting agencies, and they can update the credit report with a new score, removing that derogatory item. Right.
Now, here in the DMV, obviously, there's a lot of military. There's a lot of people using a veteran loan. Can you share? I think some things have changed just even within the last couple of years that many veterans may not know about. Can you share kind of what's the newest up-to-date on a VA loan?
Well, they are amazing. It's my favorite loan. What a lot of people don't know, and it may be that we're not at that point just because of its seller's market, but on a VA loan, anything that's not used from a seller credit perspective can be used to pay down debt. So that's a key piece. But I think the biggest thing is the debt ratios can go a little bit further with VA. They can go up to, we've seen some get approved with 55% debt ratios. And the one biggest piece with VA that changed last year is there's no loan limits. Now, there's no loan limits if you don't own a property with a VA home at the time you close. So you could, if you qualified from a debt ratio perspective, go in and buy a $2 million property with no money down.
Wow.
Yes.
And what's the difference if let's say I own a home in Oklahoma and that home's $200,000, how does that impact me in the DMV?
So the VA at that point has county loan limits, which in this area would be 822, 375 for most of the DMV. There's certain pockets that aren't that high. Then we would have to take, there's a calculation that we do, and it's based off of your original loan amount on that Oklahoma property. So you can still use that VA benefit. It may be that you have to bring a little bit of money to buy the size of home that you want. And it could be that you have enough left over that you can purchase, a $500,000 home with no money down. The rumor that you can't own two VA properties at the same time it's a rumor, because you can, as long as you have enough entitlement left or money to put down on the next home.
And what's the percentage of money they have to use to put down on the next home?
None.
Well, if they own another home somewhere else.
It really depends. It's another one of those. There's a calculation, and we have to see what their original loan amount was on the first property to see how much entitlement they have left over, because that's the key piece. And we don't know that until we know what the exact loan amount was on the original property.
Sure. Well, we have a lot of veterans that, they're now retired from the military, and perhaps they're now serving in the civilian sector, and they go to use their VA loan. What do they need to know about either disability or different options when it comes to percentage of the disabilities?
So if you have disability from 10% to 100%, you do not have to pay the funding fee for the VA. The VA has no mortgage insurance. They have what's called a funding fee. And if you've used it before, that fee would be 3.6% if you're not putting any money down. But if you are a disabled veteran, you don't have that funding fee, no matter if you're 10% or 100%. And I think a lot of people forget about that, but that is why I am a big proponent of VA loans on purchases, especially if they don't have to put money down, rates are as low as they are, and there's no funding fee. It really is a great option for them. Closing costs on a VA loan are a lot cheaper as well. Most lenders don't charge lender fees for a VA loan. So closing costs can go down drastically on a VA loan versus a conventional loan. And I've been seeing more and more listing agents become well versed in VA loans, and they're accepting some of those contracts because everyone used to hate VA loans because of the appraisal piece. And we've had a lot of success with the appraisers in our area just because we have such a strong military base in Northern Virginia.
Sure. Yeah. Let's go back and let's think through this. So they own a home right now. They want to remodel the kitchen. They want to do the bathrooms, or maybe they've been searching. They can't find anything they want. Maybe they want to put an addition on the home. And so they want to, quote unquote, tap into that equity and do what's called a cash out refinance. What does that cost? Is a cash out refinance higher than a normal refinance?
On a VA loan, or just in general?
Just in general.
The rates on a cash out refinance are a little bit higher than on a standard refinance. And on a cash out refinance, you can typically only go up to 80% of the value of the home. So, you may not have a lot of people that have 20% equity or more than that to be able to pull the cash to do so.
Well, now you got me curious. Is it different on a VA?
On a VA, they can go up to 90%. There are some lenders that will do 100% financing on a cash out, but they are few and far between just because the VA did change some of their guidelines for it. And most lenders are capped at 90% on a cash out refinance for a VA.
Let's break out that crystal ball. Where do you see interest rates going?
They've ticked up over the past 2 weeks, and I think that we're still going to remain low. Fannie and Freddie have said that they're going to keep, the Fed has said that they're going to keep rates low for the next couple of months just because of the COVID pandemic. I see them not going up a whole lot, but I don't see them staying as low as they have been for quite some time. You've taken economics, James, basically this is free money right now with rates as low as they are. So I do think that, with the increase this past couple of weeks, I think that we're looking at them trickling up just a little bit more. But of course, I don't have a crystal ball, but I don't see them dropping drastically like they were before.
Okay, makes sense. Now, those that are sitting here listening and thinking, well, my grandfather or my father always said I should pay off my mortgage as soon as possible. And, we even have on a 30-year fixed, and you can tell me, Melissa, if this is correct, that if you pay one additional payment, it shrinks that mortgage when it could be paid off. Do you know what the typical math is on that?
About 7 to 8 years it could take off if you start immediately paying that one extra payment every year. Because you are, from the beginning, it makes more of an impact because, when you're looking at that horrid amortization schedule, you see that the majority of the interest is paid up front. If you hit it with the principal payment, from the very beginning, you're doing more to reduce that principal balance.
Sure. Melissa, this podcast is called Legacy Elevated, and we love to get together with thought leaders and true professionals in their field to find out what are you doing on either a consistent or an annual basis to truly create the legacy you want to leave behind when it comes to your business and to the community. Can you share with us some things that you've done in your business? I know you have, or I wouldn't put you on the spot, of what it means to give back to you.
Well, I always treat all of my clients as if they were family because I am not a proponent of me spending money on leads. I want people to feel like I'm part of their family, and that's how I get business. And I'm also a big proponent of giving back to veterans. Veterans hold a very special place to my heart, and a part of my business I do contribute quite a bit to veterans in different organizations. But for me, treating everyone as if they were my own family, I think that makes a big impact because everyone is they get fearful when they talk about their finances, and it shouldn't be a fearful process. It should be pretty easy, and they just need to feel like they're talking to their mom at this point.
You're everybody's mom, huh? You're ready to talk
Well,
to them.
I am.
Yeah, I love it. Okay, this is going to be a tough part of it. I'm going to ask you a series of questions, and you have to say the first thing that comes to your mind. Are you ready?
Oh, gosh. Mm-hmm.
Favorite season?
Fall.
Favorite musical artist? First
Dolly
thing that
Parton.
comes. Dolly Parton. Nice. Favorite song?
Amazing Grace.
Cartoon?
Tom and Jerry.
Movie?
Top Gun.
Book?
Oh, James.
James, the book of the Bible. That's a great book.
Yes, it is. Sorry.
Favorite podcast?
This is tough, James.
Okay. Favorite president?
I'm sorry. Reagan.
Favorite quote?
Oh my goodness, you're so tough. You are so tough, James.
Favorite, I will give you the opportunity to share the favorite life principle that you hope not only your daughter embraces, but all that you know.
Treat everyone with love and grace. And that's just, I think a lot of people need to do that right now.
Oh, absolutely. Now's a pivotal time to do that. So, Melissa, we want you to use this as a quick commercial for how do they find you, how do they learn more, and how do they get protected by the mama bear of finance?
Well, my website is www.melissabellmortgage.com. They can go on and get some useful information. And my cell phone is always the best, and that number is 817-807-1616.
Love it. Thank you so much, Melissa.
Thank you, James.
Thank you for joining us for the Legacy Elevated podcast, where we reveal the ways to impact the world and leave a legacy that empowers the next generation. Follow us at Legacy Elevated on YouTube and Instagram. And if you have a business that can inspire others, reach out to us today.